Hello guys, welcome back. This is Frank Wise. So in today's video, we're going to be talking about FVG. We're going to be talking about what an FVG is. We're going to be talking about how it forms, why it matters during trading analysis, and different types of FVGs. Now let's dive straight into the video. So what is an FVG? I will say that an FVG is a price imbalance on the chart created when price moves too fast in one direction, leaving a gap. So there are basically so many terminologies people call FVGs. FVG, which is fair value gap, imbalance. People call it imbalance. People call it just gap. So basically, they mean just the same thing. So why does this matter? Price usually comes back here to fill or mitigate that gap. Come back to fill or mitigate that gap before continuing the move. So traders usually use it to spot entries, target, and confirm structure. So traders use this to spot entries and the rest of them. So types of fair value gap, which is bullish FVG and bearish FVG. So in bullish FVG, there are two types. In bullish FVG, we have that this is when when the gap forms a strong move to the upside. Okay, so the gap forms a strong move up, while the bearish FVG is when the gap forms a strong move down to the downside. Okay, so there are different types of FVG. It's just the gap. So now let's show you guys a quick example or sketch of what we mean. Now look at this diagram here. Look at this sketch over here. Look at this first candle. Look at the top on the lower wick of the first candle. Look at the upper wick of the third candle. Now look at this gap in between this first and third candles. Okay, and we call that gap an FVG. Okay, pay close attention to the lower wick of the first candle and the upper wick of the third candle. So that gap in between is it. Now look at this second example here. Now look at the wick of this first candle, and the wick of the upper wick of the third candle closes into the lower wick of the first candle. So basically this is not an FVG. Okay, so say that is not FVG. So pay close attention and correctly mark out FVGs very well when spotted in the charts. Okay, so correctly mark them out when you see them in the chart. Now let me show you. Okay, let me just write this on top and show you and differentiate both of them. This first one we said is a very good and clean FVG. Okay, because there is a gap in between the first and third candles, and then we don't use the body of the candle. Okay, don't use the body of the candle to mark out the FVG. You have to use the wick of the candle. You have to use the wick of the candle. You have to take note of the wick of the candles. So the first one is a good one, the second one is not. Let me show you guys a quick example on the chart. Okay, I'm gonna mark out FVGs that are mitigated, bullish FVGs that are mitigated when price taps into it and push back to the upside. Okay, so price tapped into this FVG, move to the upside. Price tapped this FVG, this bullish FVG, move to the upside. Remember, bullish FVG will have to go with a bullish candle, the bearish one with a bearish candle. So price tap this FVG and move to the upside. This is an FVG too, but this is not in a good demand zone. Now, price will only tap into this bullish FVG and move in the upside only when it's reacting from a good demand zone. Okay, now look at this bearish FVG. Okay, it's in a bearish candle, but because we say that price is going to tap into an FVG and move into the downside, it has to be from a valid supply zone. Okay, it has to be from a valid demand or supply zone before it can move from there. So this is our price attraction. Okay, you can take entries from here. These zones attract price. Okay, these zones attract price, so price can just basically come into that zone and then move up, and then you can use it to have your targets. Okay, because you know that price is going to keep come and fill these zones, fill these FVGs, so we can just come and put our take profit there. So that is why. So, but we can also take a trade using this FVG from 50% of this FVG, okay, which is the discount zone of this FVG. So, which is basically dividing the FVG into two, 50%, okay, dividing it into two equal halves, the premium and the discount, okay. So we take it from the discount zone just for more refinement, for more reward and the same risk, okay. So if you look at the first trade, if you look at the first trade, you have the same risk and lower reward, but this one will have the same risk and higher reward. So thank you guys for watching. Pay close attention to FVGs. Don't forget to like and subscribe. Thank you guys for watching.